All right.
All right, we are back with Gareth Soloway, Chief Market Strategist of In the Money Stocks. Gareth is a very busy man these days. He has given us a special treat, taking a little time out on Sunday to set us up for the week ahead and what we can expect in the markets and the Fed. A lot going on. So, Gareth, how you doing?
I'm doing really well, Greg. Thanks for having me, and thanks for taking time out on your Sunday as well, because I know a lot of people are interested in what's going on. There's so many crazy things going on right now.
Yeah, it's important. And, this is probably arguably one of the biggest weeks in policy from the Fed that we have ahead of us here in a long, long time. So, let's talk a little bit about that in terms of, what you're hearing and seeing, in your circles. What are the expectations?
Right. Yeah. So, I mean, we have the Federal Reserve meeting this week. I joked late last week on Twitter that if the market kept falling at the rate it has been, the Fed might even stop their tapering by their next meeting. Now, I don't really think they will do that, but you have to start to say to yourself, there's going to be an inflection point where markets dropping, there's such a wealth destruction and it could impact the economy. And then do you start to see the layoffs rise, which raises the unemployment rate? And then at what point is that the inversion, right, where they start saying, okay, well, we can accept 5% inflation instead of 2 because we have to attack the unemployment rate again and start bringing that down. And that means them, backing off on raising rates and taking their balance sheet down, all that fun stuff.
Yeah. And, the Fed has two mandates, right? Stable prices and full employment. They do not have a mandate to prop up the markets or the economy. And what's interesting is a lot of people don't realize, but QE started back in 2008 and 9, which Bitcoin was created on the back of or after that, 2009 financial crisis because of what was happening and, the QE that was coming out. And, worldwide, that's kind of when QE started. Actually, Japan probably had the first test case and it didn't work out so well for them. What do you think they're going to do? Do you think the markets are testing the Fed's resolve to see how hawkish they're going to come out, how strict they're going to come out on policy, or do you think this is just baking in what they already expect?
Yeah, so I do think it's a test, right? I mean, everything's a test when it comes to the Fed. We saw it in 2018, and it was so interesting because going up into this period, I was kept on saying, and I think even with you, we talked about how, now they're starting to taper, which is tightening in and of itself. And in 2018, we know what happened. Markets dropped about 20% in 6 weeks at the end of the year, basically the market throwing a tantrum. Well, here we are 2.0 starting over again. And again, the question is, at what point does the Fed back off? Now, again, the Fed, you're right. They don't have to prop up. Their mandate doesn't say we have to keep the stock market high. We have to keep the economy strong. But remember, the economy now is so tied to the stock market. You have more people invested in stocks than basically ever before. So there is a tie there. And I think that's what's going to worry the Fed. Now, I still think that the Fed will taper. They'll fully taper. They brought in the stimulus, right, because of COVID. That was their excuse to bring in 120 billion a month. So I think they want to get rid of that. But at the same time, then the question comes in, well, how many rate hikes are they going to do in 2022? I think the market had priced in 4. I don't think they do that. I think 2 at most, maybe just 1, because I do think the market will drop to the point where they have to start saying, okay, we don't want to see a massive recession hit or maybe even a bigger bubble collapse.
Yeah. So what everybody's expecting right now is Powell's going to say, okay, we're going to start with a 1/4 point rate hike. We're going to, accelerate the taper and we're going to start reducing the balance sheet. So that's what the last messaging from the Fed was, and that's what everybody expects. And if they do that, if he comes out and says that, do you expect a little bit of a bounce next week off of that news because it's already priced in?
Yeah, and I think Powell is going to do his best to say, okay, we're still going to taper, but I'm going to reiterate that the Fed is here. If things start turning south, we will come out and be lenient again. And I think he's going to try to thread that needle where he can still kind of taper, because he doesn't, the Fed doesn't want to look like they have totally no backbone, right? They want the market to know that the Fed is supposedly in charge, although I disagree with that, but that's what they want to portray. So then again, they're going to try to thread that needle, I think, in the meeting and the statement this week. And Powell has his press conference to do it. And usually he's able to do it, right? We usually do see the markets rally during his press conference. So again, that's the question. If we continue to sell off into that, I do think you get a technical bounce in the market. Markets are oversold. There's no doubt about it. I mean, you've had tech stocks that, I mean, were ridiculously priced, but there's a lot of tech stocks down 50, 60, 70% off of their 52-week highs, which is insane at this point.
Yeah. And if he comes out and really drops the hammer and says, we're going to have a half of a point rate hike, we're going to eliminate the balance sheet, we're going to stop taper right now, beginning in March, then what happens?
Yeah, I mean, if you see the Fed totally back off and say all of a sudden, hey, we're not going to do anything else, I mean, number one, I would be floored, right? I mean, that would just knock me out of my seat. But if they did do that, I think the markets would initially get a big push up. And then I do think that they would turn around and sell off maybe within days or even that day. And the thing is, like, the Fed has to show that they're in control, but if they were to just back off totally, then the market, it's basically sending a signal that the Fed will tolerate 10, 15, 20% hyperinflation, which, by the way, would be amazing for gold, probably amazing for Bitcoin as well. But again, it does send signals to the overall economy that there's going to be trouble with inflation that's not going to be controlled.
Yeah. They have to walk a tight line here with this messaging. And
they've done this to themselves in many ways, right? They've backed themselves into this corner, and it's a corner that I talked about for years at this point, where eventually, once you do get inflation, then how do they handle it, right? I mean, it's easy to drop interest rates and print money when you have inflation at 2% or under, but what do you do now with 7 or 8% inflation? You can't just easily print $1 trillion or 5 trillion or 10 trillion more in this situation. So they have to figure it out. And honestly, I don't know if there's any good situational outcome.
Yeah. This has been the biggest run up in stock markets, since really the dot-com era. When you look at the lows before the dot-com era, after the 80s sell off, what was it, 87 market crash? So if you take that low to the high of the 2000s, it was about 600-700%, something like that. And if you go back to the bottom at 2008-9, when QE started, to now, we're up about 600 and something percent.
It's a little freaky.
We're up only, each index is a little bit plus or minus, but, on average about 600% since 2008-9, over 100% in the last, 22 months since the March lows of the pandemic, with the $1 trillion that's been pumped in. So something has to give. And I think we saw, like you say, back in 2018, what was that, about 20-30%, depending on the index? I think the NASDAQ took the biggest hit.
Yep. Yeah, that's right. So, I mean, it makes sense that would be at least, plausible to see that type of sell-off. And then the question I have is do we see that, we know that there's a lot of fluff in the system, that there's bubbles in the system, and on the way down, do things get triggered that then create a bigger crisis? And I think that's going to be the next thing for the Fed, is to try to stomp out these fires, because you will have crises in maybe the real estate mortgage side of things if housing prices start to collapse too quickly. And how quickly can they kind of plug those holes, and can they plug them all?
Yeah. And the real estate market's a whole different, puzzle piece in the equation, in the conversation. And that's interest rate driven as well. So we know valuations in stock markets, PEs, in companies, it's all been driven on interest rates. And, all the talking heads and the financial analysts and the, investment bankers were coming out on CNBC all last year saying, we've got plenty of upside as long as the Fed, policy remains intact. We still have plenty of upside, and these valuations make sense given the current interest rate environment. And with real estate, it's all about income. People, general average housing costs for the average American middle class, they're buying houses based on payments. So it's all about interest rates. And generally, for every 1% rates increase, which are based off treasuries, that's going to affect the value of housing by 10 to 15%.
Yeah. And isn't it great, Greg, that after 2008, 2009, they fixed the too big to fail situation, and we don't have that issue now to deal with?
Yeah, absolutely. So a little bit different this time, not quite like that. We can see value destruction, but we don't have the toxic assets that are out there in the residential market, because this time around, people had to put money down. You had to qualify for a loan. Generally, I mean, there's a few different areas.
I mean,
Yeah.
I heard that things were getting a little loose again, like, 5% down and stuff like that. And the question is, you've had people buying houses over the last couple of years like crazy, right? The housing market is crazy. I mean, if you see housing prices cut by 40%, how many of the, and let's say if the economy drops substantially, how many of those people just say, hey, I bought this house for $500,000, it's only worth 300 now. And I lost my job. Do I still pay my mortgage? So I'm not convinced that, we haven't done a replication of this and that there could be quite a big hit in that regard.
Yeah, strategic default, is what you're talking about, that we saw back in 08, 09, where people a lot of times didn't have any money down, if very little. And when the house lost, so much value, they're like, look, I've got nothing at risk here. So they just turned the keys over and just did a strategic default. This time, like I said, it's a little different. There's a small percentage that only put 5% down. The bulk of the buyers in the last couple of years had to put that 20% down. But yeah, that loss of equity is a big, big deal, because, that's what people are counting on. And they've seen 20,
Right.
30% appreciation the last couple of years. But, that's a different conversation. So,
and I mean, that goes through every asset class, right? So you have housing, where people are just conditioned to think, okay, housing prices grinding up 10%, sometimes more a year. Equities, all right, I can just put money in stocks, buy every dip. It's going to keep going higher. Crypto, it's going to keep going up and up and up. And that's the biggest issue here is what happens when you see all of these assets collapse, even 20 or 30% across the board? What does that do to personal wealth? And then in return, how does that affect spending by the consumer in the economy? And does that ripple through into a recession?
That's the big gotcha right there in the whole equation, is that wealth deteriorates, markets, real estate, cryptos, that affects people's behavior, outside of those markets, which affects the real economy. And we have inflation on top of it. So it's a very dicey situation that the Fed has on its hands right now.
Yep.
And, it'll be interesting to see what they do next week. So what are you looking for Monday? How do you think the markets are going to open? What we've seen is last week sell off, maybe a little bounce in the morning, but then that weakness of selling into the afternoon. So what do you think Monday's going to look like?
So Monday, it's tricky, right? So one of the things that I said on Friday and on Saturday was that the worst thing for cryptocurrency was that the stock market closed, and it closed at the lows, right? Because, investors are very emotional. So with the stock market closing at the lows, down again 2% or whatever it was, you had investors saying, oh my God, I'm freaking out. I can't sell stocks. So what am I going to do? I'm going to sell crypto. And we saw cryptocurrency prices take a 20% plus hit on many cryptos from Friday into Saturday. I mean, it was just a bloodbath. Now you're coming into the stock market being oversold, right? In fact, let's take a look at the S&P 500 chart here, or the SPY chart, and get our bearings on this, because and I started doing this on Thursday and Friday, I'm starting to accumulate a few plays, very small positions, but I do think you're coming very close to an S&P 500 bounce. So again, notice this is one of the most amazing channels that I've, in all fairness, that I've ever seen in my career. It goes back to basically the first initial bounce from COVID, March 2020. And you can see how the market was in this range. Look at what's happened recently. We finally broke trend. And that means to me that you now have gone from an upward market that has continued to make new all-time highs to a market that likely will see bounces, big bounces, but likely won't make new all-time highs and will ultimately make new lows. Now, looking at the charts, you are coming in on the S&P 500 to some big support. There's a gap fill right here, right, which we are very, very close to. And then you also have this pivot down here. So I don't know, in terms of where the market's open tomorrow, I think there's a couple scenarios. One is you could have a gap down that's nasty, and then it gets bought and you start to see a big rally there. Or maybe you chop around early and you kind of just start rallying back off the lows. I'd kind of go with the gap down scenario, because I think there's a lot of pent up fear that could drive initially prices lower. Maybe at the open, we see a big sell off as well. But I actually am pricing in a bounce either late Monday or into Tuesday in the equity markets. And I think it'll be technology related. And I think a lot of what we're going to see here is that the market is going to start anticipating, and you're going to see a lot of institutional buying that is going to say, okay, the Fed will come out and try to soothe things. So we need to buy some of these major collapse stocks to get those bounces. And again, I mean, it's a dime a dozen, right? But I mean, you could go to so many of these names, whether it's a Peloton being overdone to the downside, or it's a Fastly, or it's a, AI or SE. Take a look at C Limited here. I mean, this is just remarkable. Now, it had no reason to be up at $370, But I mean, the destruction in price here, it looks like a cryptocurrency chart, to be honest. 375 in late October. And here we are, in late January or mid-January, and it's $150. So you're talking about 65% drop in price in a couple months, when it took, if you look back at how long it took the price to rise. And the same thing for stocks like NE is another one. This is, Cloudflare. I mean, look at that move up, which it shouldn't have done. But now look at the collapse in a straight line. And this is where I get interested, right? And let me remove those lines here. So look at this pivot high right here, which we've now crossed below. And then look at this pivot right here, which we actually hit on Friday. And all this chop, there should be major support here for a technical bounce. Now, down the line, I honestly think we're probably, going lower, but you have to think that we're due for at least a technical bounce here.
Yeah. So that chart, those charts you just showed, most of, Bitcoin and the other altcoins in the cryptocurrency markets are looking about the same, where you've seen this little consolidation, major rise, and a lot of the altcoins have dropped 60-70%. Bitcoin's down 50 at this point. So is Ethereum, in that little consolidation zone where, I feel like we're going to put in a little bit of a local bottom right now, but yeah, that's what we've seen. We've seen the market. Sometimes it'll sell off in the morning, then it bounces back by noon, or it'll bounce in the morning, stabilize at noon, but it's been selling into the close pretty much every day, which to me, that's just weakness and, investors de-risking. And now what's interesting, over the last, 22 months since the pandemic, I think it's crystal clear that Bitcoin and crypto are simply risk-on assets. They're risk assets, they're speculative, and it's all about money supply, meaning, when I say money supply, meaning liquidity, it's all about liquidity, not in terms of Bitcoin as a liquid asset, cryptos are liquid assets, but the liquidity coming into the markets, that $1 trillion that drove all, stocks and cryptos over the last 22 months. So, I think,
and just the other day I was saying is that, crypto people love to hate on the Federal Reserve and say, oh, they're printing so much money, they're screwing up, they're crushing it. But in reality, cryptocurrency is very much tied to the printing of money and the Fed continuing to print money to kind of continue to go up and get inflated as an asset. And ultimately, the long term of Bitcoin is the same thing, where the more dollars in the system, the idea is that you get that kind of digital gold, that offset factor.
Yeah, I mean, that's really the only reason. So you have on-chain metrics, you have, fundamentals and all that of the Bitcoin and crypto space. And, Bitcoin's not going anywhere. Crypto, some of the projects, some of the, sectors aren't going anywhere. But the valuations, just like you just showed with all of these tech stocks, and pick any of them, Tesla, Apple, all of them, the valuations didn't make any sense. Same thing here. It's all been, liquidity driven. In terms of where we're at. So we're just coming back down to where they could, where they need to be. And, people that have been in the space, prior to 2018, 2017, it's hard for them to see anything different, because it was all about the network effect prior to really broad scale institutional participation, not adoption, but participation in the space in that 2017, 2018 timeframe, when you really saw the run up to 20. And then we had that long consolidation till, this last year. And, what a lot of people aren't understanding and not seeing is the biggest driver of crypto, what's going to really drive values and drive the price of these assets in the future are, the boomers. There's 30 trillion investable dollars out there in the United States alone in IRAs, and, the aging population, the boomers, most of them don't know about it, don't know how to get into it, are afraid of it. That's where the real adoption, everybody's, thinking that the real money is coming from institutions. It's really the general population that has money to invest, that's really afraid of the space or doesn't understand it, that has yet to hit the crypto markets. What we've seen in the last couple of years is just speculative dollars, basically from, investment banks, high net worth individuals, things like that.
Yeah, and there's no doubt that you need that adoption. And I've gone on record saying, if you need to see that regulation coming in, not that you don't want it to hurt Bitcoin, but you just want to make it safer so people feel more comfortable investing, right? I mean, I think that's very, very important. And I think, honestly, crypto is now starting its dot-com collapse period. And I think I said that even in the end of last year, is that you have to have this washout. I mean, when you have, what do you have, 10,000 cryptocurrencies out there, most of them are nonsense. I mean, you have meme coins that were created as jokes. You got to get that to flush out. You got to get those to go to zero. And then again, just like the dot-com era with Amazon dropped 95% when dot-coms collapsed, and then look at where it is now. I mean, if you bought at $5 back in, or, early 2000s, look at where you would have made your money. And I do think that will be Bitcoin eventually, and maybe Ether and some of these other ones, but you got to get the flush out. And I do think it's begun.
Yeah, in Bitcoin, yeah, we've it's been tested over the last 11 years since its existence, and up and down, up and down. Mm-hmm. We've seen the last couple of real bad downswings that that $3,000 to $4,000 seems to be the minimum that Bitcoin has the potential to go to. It's not going to go to zero. It could, I'm not going to say nothing is impossible, but it hasn't gone below that in the worst economic times. 2018, the Fed was pulling the foot off the gas. We saw market sell off. Bitcoin and crypto sold off, and Bitcoin hit a low of about 4,000. And then in the March pandemic, the biggest panic. Now, what we don't know is, and what we haven't seen a bear market, since before 2009. So we don't even know what a bear market looks like in this day and age with Fed involvement, because prior to that, we didn't have the Fed.
Right.
So we don't know what is a bear market. Can we have one? What is that going to look like? Financial markets. What would that even look like?
Right.
Crypto, it's consolidation. It's what we're seeing now. And, the question really becomes, what is that floor on Bitcoin now? And I think it's trying to find that. And, but what we do know, what we can take comfort in, is the last time it only got down to about 4,000 before the Fed stepped in, and then bam, we were off to the races again. So You can say that might be the floor. And then we know that we now have a $70,000 ceiling, 6970, that was Fed driven, that was liquidity driven, not fundamental. That was all liquidity. And I think everybody realizes that now. So the real question is, where are we now? Where's our ceiling going to be? Can we get to that 100,000 level? Where's the fair value going to be once the dust settles? And I think, unfortunately, that's in the hands of the Fed right now.
Yeah. Yeah, I agree. I agree with you. And for me, I'm just using, the best I can with charting and looking at history for Bitcoin. So for me, I'm looking at like 2013, there was about an 85% drop on Bitcoin from the highs. In 2017, another 85% drop. So that's kind of my worst case scenario. I could see it going down. And I think that would take us to right around the 10,000 level, which was a major pivot prior to the breakout that took us up to where we are currently. Now, you could argue that there's a Head and Shoulders that's still valid, that has a price target of around 17,000, 16,000. So either way, I'm still in the camp, and I said this since last year, is that I still think we're going sub 20,000. But for investors, I do think, I always like to remind people that it's not all doom and gloom, right? I mean, if I'm right, then you see a lot more upside in the future when kind of the dust settles. And again, it's just a matter of dealing with another crypto winter or bear market like we've seen, in 2013, 2017, now 2021. And again, I remind people, I said this for so many times, it's 4 years apart. It seems to be the cycle with Bitcoin, and it continues to be such.
Yeah. Which, that cycle is lengthening a little bit. We'll look at the Bitcoin chart in a second, because I want to challenge that 20,000 theory, on there. But as far as, so Bitcoin's one thing, it's not going away. It's a different animal, whereas digital property, right? So Bitcoin's digital property. Altcoins and cryptocurrencies are a very different thing. And those can go away. And we've seen a lot of them go away, like you just said. And if you think about tech stocks and, the MySpaces and, the Best Buy, or not the Best Buys, but the, what did Netflix play? Blockbusters, so when you think about, emerging technologies and things like that, there's a lot of projects, there's a lot of tokens, and, a lot of areas of the crypto space that won't be here as we evolve, because technology evolves, all of those things. But Bitcoin is very different. So, so let's take a look at what you just ran through there in terms of your theory or thesis, based on what we were just talking about.
Yeah, I mean, again, it's hard to see on my chart going back to 2013, but you actually had a drop from I think it was about 1,300 back to about 200. Then in 2017, 20,000 back to about 3,500. And then again, the idea being is that if you do get that same sort of collapse, which arguably I think there's positives and negatives to that, right? So you have more people in this space, which means there could potentially be more buyers because there's more people paying attention. So people would say, okay, maybe it doesn't go that low, but I would then counter and say, okay, but there's more people that will freak out and just freak out and dump as well. So does that then mitigate that as well? So there's a lot of, there's so many different things. One thing I do want to point out, and again, this is getting a little shorter term, but I was accumulating a little Bitcoin over the last, few days when it was trading, 34, 35,000. And I just want to show something that at least for me tells me that in this week, I do think we get a technical bounce here. And let me just see if I can remember how to do this on the chart. So if you connect this high with this high, so you're taking the April high to the high that we put in early November, right? So let's do that here. Okay. And then stretch it down to the lows that we put in here, right? So take it down to the low here. Let me just try to get this as accurately as possible and then stretch it out. Look at that.
Mm-hmm.
So basically so we have now corrected the same amount of distance from the high in April to the lows before the run up to the highs in October, November to the lows here. Same distance. You can see the perfect parallel trend lines. So on a technical basis, I don't necessarily think this is the low on Bitcoin for the next year or so, but I do think at least for the next week, week and a half, 2 weeks, 5 weeks, I don't know, but I do think you are due for some sort of technical bounce. And I think the fear out there is very palpable at this time in Bitcoin.
Yeah, and I'm with you. I put something out the other day, and I had the bottom coming in temporarily, in this, and again, the Fed caveat, right? No matter if the Fed does something crazy, all bets are off. But if the Fed comes out, everything is as expected. I feel like we have a local bottom in that 35, 36 before we get. So traditionally, Bitcoin is going to retrace to that, 6.8. 618 to 702, fib level. And before it goes off into a longer, more sustained consolidation or bear market. And then after that retracement enduring is when some of the altcoins will run. So that's kind of what I'm expecting, is that bottom to come in around 35, 36. We wick down into the 34 range, but then kind of now start moving into that retracement up into the 50, 60 level before you see more of a sustained downtrend on Bitcoin for a little bit longer term. So there's a few people in the camp that, that's what we can expect. And then of course, if we do get a strong enough bounce and there is enough confidence and you get, broad investment, liquidity back into the market, it could just go off to, maybe set a new all-time high again.
Yeah. You're 100%
in
right
your
on
channel.
That. Yeah. So that'll be so fascinating to watch. But in the very least, I'm totally in agreement with you that, I don't know how high the bounce goes. I think, minimally you'll have resistance now at 40,000. I mean, that's going to be short-term resistance. That was where we were hitting right here. And then we hit it right here. We broke it. So that's now resistance on the upside. But my guess is you'll see the same tie. So as soon as you see these tech stocks like C and some of the ones we mentioned earlier, Cloudflare, and I mean, there's just so many beaten down tech stocks. When they start getting a bounce, that's exactly when Bitcoin will also catch a bid. So in that theory, if we do see a bounce in tech stocks and the markets this week, then you likely will see crypto get a nice little bounce as well.
So let's take a look at your downside case in terms of, those lower levels that you think are still potentially on the table, with a head and shoulders or, whatever technicals that could potentially play out here.
Mm-hmm. Yeah. So one of the things I'm still keeping an eye on is the potential for the head and shoulders here, right? So, if you use this long wick down here and you kind of watch it there, right? So you had this kind of head and shoulders. You can even connect this trend line right to here, which makes a lot of sense, right? Because you had this hit, and then this hit. And then notice when we broke, we kind of retraced to it before falling again. And again, if you take the highest level here and drop a plumb line down, you take that distance and replicate it to the break. Well, really the break was here, and you bring it really down around here. So just sub 20,000. So that's the first calculation of where Bitcoin could ultimately bottom out, right? And then the second case is, again, if you go back to 2013, 2017, each time you saw about an 85% drop off of the all-time highs before it really put in a bottom. After it put in a bottom, remember, it actually spent a year kind of just chopping around. It would bounce. In 2018, it bounced from 3,500 back to like 10,000, then back to 5,000, all that kind of chop before finally breaking out in 2020 to the upside. So again, this is where I'm at this point. Again, the base case for that downside is the Fed is going to remain more hawkish, right? So if they don't come to rescue the markets too quickly, then that's also a negative for Bitcoin. But again, I think that, by later this year, I would be shocked if the Fed is still as hawkish as they are now. I would be absolutely shocked.
Yeah, they're not going to be able to be. And,
No.
and I think things are different this time, because last time we had the same kind of scenario playing out. When we started chopping in that $35,000 to $45,000 range at the lows before July, it looked like from a technical standpoint, and the fundamentals of the market, we should have gone lower. We should have tested that $20,000 level, which arguably was the start of the run up. But there was so much liquidity coming into the markets. There was so much interest and awareness, from the, investment banking world, institutional space, that, potentially what we saw was the floor was 30,000, 29. I'm wondering if that is the floor and that we're just not going to break that level, because there is so many people bought at that level at the high end. So many banks and investors and hedge funds that have a basis, Michael Saylor, a la Michael
Right.
Saylor.
I was just going to mention Michael Saylor. I think that's their average price, right? Right.
Yeah, 30,000. So that seems to be where a lot of that institutional, big investment bank money and their clients have bought, in, or where their average is.
Mm-hmm.
So, I'm wondering if they will let it go below that, because, they have the funds to keep it propped up above that, which that move off of it is, that was a manipulated move, bringing the price back up twice to get it back to that 69, and spark interest. So as we get to the backside of the cliff, if the Fed, is doing what we think they're going to do, if they're going to be, hawkish, but not, really bad, then arguably we should be able to put that floor in and kind of keep going and inch our way back up in that channel. So I don't know. I'm just wondering if it's possible, given the current environment. The only reason it got as low as it got last time is because of the pandemic. It was on its way up again before the pandemic hit. We were in that $10,000 range before the pandemic hit. Right. And we probably would have made it back up to, we would have breached 20,000. I don't know how far it would have gone without the Fed, involvement.
I mean, it'll be interesting to see about that 30,000 level. The one issue I have with the 30,000 level is that, everyone's assuming that's the low, and oftentimes, that's where they want to flush it below, or price ends up flushing through. And really, every new asset, right? And again, I keep on bringing it back to the .coms, but you had this brand new technology. The internet was emerging. It was amazing. Everyone was so excited. You had all this crap out there that shouldn't have been out there. And eventually the market had to wipe out 95% of the .coms. The ones that survived were awesome, right? But if it doesn't do it this time, when does it do that? I mean, when do you see some of these cryptocurrencies get wiped out? If 30,000 is only 5,000 points away here, or $5,000 away, that certainly isn't going to wipe out these other 10,000 cryptos. And again, I'm thinking honestly, like 20, maybe 50 cryptos will survive and thrive in the future. It's not going to be, in my opinion, because there's just not enough space for them to, what is this one going to do? What's this one going to do? They're going to overlap, and people are going to gravitate towards the best of the best. So then that would be my only question. If 30,000 holds, you don't get that type of flush out.
Yeah. And you have real competition for the dollars now with, NFTs and gaming and metaverse and all these different areas now, DeFi that, wasn't there before. But yeah. And so just to be clear, I'm not saying that's a floor. I'm not saying it can't go below that. I know you know that, but just for people watching, I'm just saying it looks like that there is enough, large whale holdings that would keep it there. But at the same token, as an investor, if I see bad things coming, I'm going to let it go and I'll take a loss just to get my capital back. So, if things do get bad in the economy, we have Russia and Ukraine. We can talk about that in a second. The big whales will sell at a point if they, feel like there's a lot of risk, and, cash is king when the chips are falling. And we saw that in, March of 2020. And, the other thing that we've seen too, there were a lot of these little rules of Bitcoin, right? That people like the hash rate indicator, where once the hash ribbon indicator flashed by, you get the blue buy signal. It never goes below the previous low set after that. Well, it happened in March of 2020, and it just happened. We just went below the previous low, which was 37,000 before the hash ribbons buy indicator flashed. The other one was, people used to say Bitcoin never goes below a previous all-time high after setting a new all-time high. Right. Well, 64, 69, now look where we're at. So
Right.
some of these rules that a lot of people in the space have seen and, and have proven over the years are not proving out now. So it is different this time. The market's different. The players are different. The liquidity is different. And, to say that Bitcoin absolutely can go here, but it can't go there, I
Right.
think is unwise. I think we need to be open to where it's going to go, where it's going to go. And the macroeconomic outlook in future is what's going to control where those prices, go.
100%, 100%. And like you said, adoption is so important. And again, you get, if I could pinpoint what I want in the next few years, I would say I do want the government to kind of say, okay, we're going to accept that crypto is here to stay. That would be huge. We're going to regulate it with these. We're going to give these accounts FDIC insurance. I mean, you have to put things in place and then you get the adoption. And I want to see eventually, you want to see pension funds that have trillions and trillions of dollars saying, okay, we now need to have, maybe it's only 3% involved, but this is another asset class that we have to invest in. And all of these things are steps that will make cryptocurrency eventually, a household holding, if you will. I don't think it's going to replace the dollar. I think that's a whole nother story about what's going to happen to the dollar longer term. But I do think you have to look at it as an alternative and kind of like a gold. For me, Bitcoin is exactly that. It's a digitalized gold where I can hopefully in the long run, not right now, but longer term, it will kind of be a place to put yourself for safety, knowing that there can only be 21 million ever mined.
Yeah, and that's really what we need. We need more regulation. We need more stabilization of the industry, the space as a whole, for broad scale adoption, not just institutions and pension funds and life companies where the big money is, sovereign wealth funds. I mean, that's where the big money is. But the average, 30 to 40 trillion dollars that's just sitting in IRAs and money markets and CDs and bank accounts that are out there that the average people that have 10, 20, 100 million or whatever just laying around that they could put into the space or part of it. And the general retail population is going to invest more as a percentage of their holdings than the institutions, the real institutions, are willing to invest. But so gold. So you've touched on gold a little bit. What are you seeing there? I know that you have come out and said you expect gold to do better than Bitcoin this year.
And the stock market too. Yeah. So far, just obviously we're only 3 weeks into the year, but so far gold has performed over 10% better than the stock market in 2022. And I think it's got to be 15 to 20% better than Bitcoin at this point. So far, so good. But bottom line is, I do love gold. Basically, it's a more stable asset during this period of uncertainty, right? So that was one of my keys going into the year of knowing that, or at least my hypothesis was that Bitcoin was going to get hit hard, cryptos were going to collapse, and that the stock market had a big pullback or correction to it. So, where else do you go? Well, I don't like real estate with interest rates rising and with prices as high as they are. So I wasn't going to go there. So I really came back to gold at that point of being, the idea that it can break out. Maybe it's only up 10 or 20% by year end. I think it could be up more, but even if it stays flat, I still think it outperforms the stocks and Bitcoin. So what I love so far, and this is going to that thesis of gold's outperformance and breakout, is that we've seen interest rates go up to basically 1.9% they touched recently. And in general, if you asked people 6 months ago or even more recently, they would say, oh, well, if interest rates go up, gold's going to go down. That's just the way it's been for 20 years. And I would counter with that. And I did counter that with you in past interviews, that it's all about why. So if it's because of inflation, then gold doesn't go down when interest rates go up. And I think that's what we've seen. And gold has performed. I mean, it hasn't ripped, but it's held up beautifully. Now, if you get interest rates to come back down, does that then push gold up even more in that scenario? And we'll have to watch and see. But one thing I do know is you have this beautiful channel here. You're now just underneath a potential breakout area here. Again, gold has performed beautifully since the start of the year. Not up a ton, but again, holding its own, grinding up a little bit. Let's see if it breaks out. And if it does, I think again, within months, you could easily be back to the all-time highs. And again, looking at the longer chart, I mean, it's just a thing of beauty here. You have this.
Where did that all-time high come in? Was that July of 2021?
August. Looks like right at the start of August. So August 2020, actually.
Okay.
So 2020.
And where is the pandemic? Where's March 2020 in here?
March 2020 was right in, here we go, right here. So this little dip right here was that, and I can zoom in a little bit. So here was your
Okay.
pandemic dip. And listen, we have to remember that anytime you have fear like you had when that thing started, when COVID started, everything got sold. Didn't matter what it was, everything did. But again, gold's recovery was remarkable there, and how it just surged to the upside really fast. And then basically what you have is you went from this massive move from 2018 all the way up to the 2020 highs. And then since then, you've been actually, I mean, this is a beautiful consolidation pattern here from that high. Notice how you're in the top like 30% of the entire move. That's classic bullish pattern. That's digestion of the big move. And digestion usually means it's got another run of equal move. So, you know, you can see these other lines I have on my chart marking, let me get rid of those. So you have this high up here. This was your high in 2020, and this was your low in 2018. And the idea is that you take this distance here and you drop that line and that distance, and you would add it on to the breakout essentially, which puts you at 2,700 potentially by year end, maybe.
Yeah, that's a good risk reward, because what I was at, looking at the March low of 2020, so that is your fire sale floor that's been set in gold. So arguably you could, from a risk standpoint, say, well, we're probably looking at, what is that, 1475 for, a floor for gold, about as low as it's potentially going to go in a, in a risk off environment.
Absolutely. Absolutely. And again, it's the idea for gold is that, the thesis for gold anyways, is exactly what we're starting to see play out, right? So the Fed says, okay, we're going to taper, inflation's too high. We have to raise interest rates to kind of calm this inflation down. And then by doing those motions, then they hurt the economy, which then creates the situation where at some point they have to kickstart the printing presses again. And you just have more and more dollars flowing into the system, which eventually rallies gold. And I actually think, going back to cryptocurrency, the pivot point where you might put in a low later this year in Bitcoin could be that trigger where the markets, let's say the stock market's down 20, 25%, Bitcoin's maybe down at 30,000 or maybe 20 or maybe 15. And when the Fed says, okay, we have to now flip it again to be more printing press happy to help unemployment come down again, that could be the trigger where you actually see the bottom in Bitcoin. Maybe. I'm just speculating, but it's possible.
Yeah, and I think that's what we're going to see. So one last thing, before we wrap up with some final thoughts, what do you think how do you think markets react to Russia invading Ukraine? What do you think that's going to look like?
Oh, man. So I think the markets are kind of keeping an eye on it, but I don't think they've really fully reacted. You could argue that some of the downside in the S&P recently could be attributed to that. I'm not necessarily a believer, because I think the markets for the most part just think it's a lot of, jockeying and kind of messing around, and they think Putin will back off. And ultimately it looks like the US, I mean, if it was a full scale invasion, I don't know what the US would do, but I just do not see the US getting into another military conflict. Again, we've just gotten out of Afghanistan. The last thing the president wants to do is commit more US deaths to a region. Now, I think we're already sending military arms to them. So I think we help them in those respects. And I think you would see massive sanctions. I mean, all the book would be thrown at Russia in terms of sanctions. But the question is, if it's just sanctions, does it really have a major impact on the US? I don't know if it does. I don't know if China, Russia's economy is not that big where it would have a big impact on the global picture. So, again, it's all speculation, but I think you would have a little bit of an impact, but it would be very short-lived. And again, think about what the markets could do. You get Russia to invade. Does that make it more likely that the Fed backs off on tightening? And maybe it turns out to be a positive for the market in the short term. It's a possibility.
Yeah, we could run the gamut with that. Yeah. I think, I'm with you. It depends on to what degree,
Right.
the invasion, is, and how it escalates. And if it escalates into a war, and you've got Russia and China against the rest of the world, and Iran, Russia, China, Iran, against the rest of the world, then yeah, that gets ugly and you'll see a big event. But if it's diplomatic and a bunch of, political posturing, with a real invasion, I think then you see energy sector will take a hit, because there's, oil and natural gas and things like that at stake, obviously commodities, wheat, corn, things like that, that might fluctuate a little bit. You might see a little tick in the markets, but yeah, I think you're right. I think, if it's mild, I don't think we're going to see much. If it gets out of control and we're talking about a multi-country conflict, then
Yeah.
then we might have some
Yeah.
issues there.
And it's so interesting too, because you also wonder if the invasion of Russia with Ukraine, could that also be something that China's watching with Taiwan, right? And they're saying, okay, well, let's see what the US and the rest of the world does. And if it's not that big of a deal, do we say, okay, well, let's go take over Taiwan at this point too? So, I mean, it's really kind of a chess match going on right now, I think.
Then you have North
And
Korea, South Korea. Yeah. So, I mean,
yeah,
who
yeah, with
knows
all
what
these different ones. And then the other side of the coin, I keep on thinking with China and with Taiwan and like you're talking about with Russia and China being on kind of the same side-ish thing is, Russia's economy is not super intertwined with ours. But you could argue that, with China, there is so much intertwining with the rest of the world, with, Europe. And the question is, do the Chinese, are they willing to risk major economic hardships, with their own people and so forth to really push that? I don't know. I think China, Russia's a different situation. They're not as intertwined.
Yeah, it's interesting, and we'll just have to see how all that unfolds. Now, something I've been thinking about too, that and we've kind of seen it, is Fed comes in, rescues the markets, and we're going back to 2008 and 9. We get these run ups, they try to pull back, they try to ease, and the markets throw a fit, they jump back in. So could we just be seeing this cycle over and over, where the Fed comes out and it's a little game? And when did he announce all this? Right, it was after everybody in Washington got out, after everybody sold, the insiders on Wall Street sold, investment bankers locked in their bonuses, and now he's coming out. Now we're seeing the sell-off. And,
Right.
these are reports in the news. Goldman, they didn't make as much money because they're paying out all these, obscene bonuses, which their clients are making money. So it's great, but it's really interesting, the timing of these things. So, we'll see a little bit of a risk off right now, a little bit of a, deleveraging going on, to a degree, and then they jump back in, prop it back up. We're off to the races again. And maybe we just repeat this cycle indefinitely. I mean, is that a
Yeah.
possibility?
I think it's a slight possibility. I do think you have these big bounces in there, but I think something has now fundamentally changed, which is this inflation, right? So, I mean, if we were back in 2% inflation, then yeah, you're right. I think you have these, the Fed coming out, but you're now in this dance where the Fed is going to have to, and the markets will watch this so closely, where they're going to be focused on, okay, if we start printing again, what does inflation go up to? And again, there's a point where, the more you print, I mean, how hard does it get for the people in poverty or the middle income people to afford to buy and maintain their lifestyle if the Fed doesn't really get inflation down? And I really am a true believer that, if you looked at Powell got reappointed by Biden, and there's no doubt that Biden must have said, hey, listen, because I mean, the alternative to Powell was what was her name? Yale Brainerd, right?
Brainerd, yeah.
And she's much more of a dove. She was much more likely to be lenient in terms of raising and tapering. And so he went with the slightly more hawkish, if there is such a thing at this point, Fed chair. But the idea, again, is you got to get, a lot of these voters, midterms coming up, we got to get inflation down. So then the Fed, the question again is going back to it, when they need to loosen, they're going to have to play this dance with inflation.
Yeah, that's the big, skeleton in the closet out there that they have to deal with. And, I think they have to deal with it. I think they have to just tell Wall Street, tough it out. You've made your money. We got to go into a little bit of a deleverage here for a while, and we're going to get inflation under control. And then we'll bring the party back. But on that, go ahead.
Well, I was just going to say, and that point too, is I think that's what it's going to be. So you have two things, right? You have two things. You have inflation and you have unemployment. So if inflation comes down a little, let's say to 5%, and if you have a situation where unemployment spikes to like 8% or 10%, the Fed is going to say, okay, which one's worse? And they're going to attack that one. And likely it'll be unemployment. And then if inflation, let's say unemployment, they get it down to 5% or 6%, but inflation goes to 10%, then they'll attack inflation again. But the problem is I feel like you're just going to continue to be back and forth, and it's not going to be ever the perfect, that we hear the Goldilocks situation. I honestly think that is gone for good until there's a whole new financial reset at some point.
Well, the discussion is, does the Fed have any business, in markets and, in QE or any of that, versus what is their mandate? Full employment, stable prices. That's it. Raise rates, lower rates to keep prices in check, and, to keep employment, as full as they possibly can. And, we saw what Paul Volcker had to do when he came in, and, double-digit interest rates, very different time back then, in terms of everything. But, at this point, the only thing that's going to stop inflation is a recession. I mean, you have to go into recession to stop inflation. Only thing they can do.
Yeah, you're 100% right.
Yeah, interesting. Well, Gareth, I appreciate you carving out some time on Sunday. It was a great discussion, and I know people are going to get a lot of value out of this. We will definitely put your information there for people that want to connect with you and link up. Tell us a little bit about what you do at In the Money Stocks. I know you have trading signals for the markets, and now you've got the crypto product as well. What is that all about?
Yeah, so verified investing crypto is for cryptocurrency trading, and we're swing traders. So believe it or not, as crypto's gone down, we've been making money by buying in at support and selling at resistance. So it's none of this kind of crazy moon boy, hope for the best type stuff. It's technical, all technical. I do a video every day. I post every trade I take in there on a swing trade basis. And same thing with my stock service at inthemoneystocks.com called Verified Investing Alerts. Daily videos on a technical analysis, what the market's doing. And same thing, every trade I take, I post there, and people can follow me basically step by step.
Yeah, it's posted for the public. Now, on the crypto side, are you using leverage at all, or is that all spot positions?
All spot positions. I'm just purely, and part of it is with the volatility in crypto. I don't feel comfortable using leverage. So I like to just kind of keep it with the money that I have. And I would recommend, especially in this day and age, when you don't know what you're going to go to bed and find out the next morning where crypto is, stick to money that you can afford to risk. That's definitely the best for this scenario.
Yeah. Leverage in the bull market, spot in the down market.
Right.
Yeah, well, good. Well, Gareth, I appreciate it, and I'll talk to you soon, hopefully.
Awesome. Thank you so much, Greg, for having me, and I can't wait till next time.
Take care.